Investing used to sound like something only financial experts or rich people could do. But in 2026, just with your smartphone and an internet connection, you can actually start investing. The problem is most beginners are confused, they are overwhelmed, and they are scared of losing their money before they even start investing. And those are valid feelings, right? It's okay to be confused, it's okay to feel overwhelmed or even be scared, right? So that's why in this video, I'll be breaking investing down in the simplest way possible. It's nothing complicated, it's just something everybody can understand. And so as you are watching this video, make sure you watch the video to the end. Let's get right into it. So what is investing and why does it matter so much? Investing simply means putting your money into something and making it grow over time. Why must you invest your money? You must invest your money because of number one, inflation. Inflation means that your cash loses value over time. And what this means is that, for example, if you saved up $1,000 in your bank account, in few years time to come, that $1,000 will only be able to buy $800 worth of stuff. We live in an economy where owning asset is far more rewarded than just earning a salary. And for instance, if somebody bought a home 20 years ago, that home will have more than doubled in value over time. Or someone that invested in the stock market, that investment will have grown 8 to 10% a year if they did it correctly. Salaries are not being that impressive and they barely be able to catch up or edge against inflation. How does the stock market work? A lot of people have heard about stock market, but only very few people actually understand. And what it simply means is that you are owning a small piece of the company. For example, if you buy a share in Coca-Cola, that means that you own a tiny fraction of Coca-Cola. And you are buying that share because you believe that that company is going to continue to make sales and increase in value over time. So therefore, the share that I bought also will also increase in value as the company is also increasing in value. You can only buy shares in a company that has gone public. And what I mean is that the company has undergone some procedures to make their shares available to the public to buy them. And in buying them, you are basically investing into that company. Well, the company being public is not the only way you can actually invest in a company. But for beginners, it's one of the easiest way to invest in a company because when a company goes public, you can actually use small amount of money to buy shares in that company. Let's say a company has gone public, the company is still private. It's more risky to actually invest in that company and need larger amount of money to invest in a private company. So when a company has gone public, it's very favorable for beginners or even experts to invest in that company because you can invest small amounts of money and it is also less risky. So where can you buy shares in this company? You can buy shares in this company on the stock exchange market. And the stock exchange market is like a marketplace for trading shares, right? Just shares alone are traded on the stock market. Stock market comprises of hundreds or even thousands of different companies. So individuals can buy tiny pieces of different companies on the stock exchange market. So think of it as a place where everybody can actually trade, buy or sell shares all over the world. And the prices of the shares of these companies can actually go up or go down depending on what people think about the company, right? If people think, oh, this company will still continue to post good profit, this company is going to continue to become valuable in the long term, yeah, what happens? The shares continue to go up or the shares remain stable, right? Or if people lose faith in the company, if people think that the company is going to not make sales anymore, or for whatever reasons, the shares can actually go down too. Now, there are two main ways to make money from the stock market. Number one is through dividend. And dividend is simply when a company decides to share its profits with its shareholders. And this happens periodically. It can happen every 3 months, it can happen every 6 months, and it can even happen annually. And keep in mind that it's not all companies that actually pay dividend. Another way to also make money from the stock market is capital gains, right? And what this simply means is that, for instance, if you buy a share in a company, let's say it's worth $20, right? After some times, if the stock of that company should go up and it's probably worth $100, right? You initially bought it at $20, is now worth $100. If you now decide to sell, you've made a profit of $80, and that profit is your capital gain. So what do I then invest in? Do I invest in Coca-Cola? Now, this is the way to go about it. The companies that are the biggest companies of today may not necessarily be the biggest companies of tomorrow. And if you look back in the 2000s, the companies that were at the top are not necessarily the companies that are at the top in 2026, right? With time, some companies may lose flavor. With time, some companies may begin to make losses, and they may lose the value that they have previously. And a very good example is BlackBerry. BlackBerry was once one of the most valuable companies in the world, but today is very, very far from it. So different things can happen, different things can come into place and makes a company that was once valuable before to no be valuable again. And now because of this, you now see that now start analyzing financial reports of individual companies and start looking and start breaking them down. To me, it seems like a lot of work. And of course, to beginners, you might find that boring and you never want to go through all that. That's why instead of trying to analyze individual companies and trying to guess who will be the winner, you can actually invest in a combination of these companies at once. And you can do that through what is called an index fund. So, what is an index fund? Think of an index fund as a big basket that contains hundreds or even thousands of shares of different companies, right? And it tracks the overall market performance. And an example of the index fund is the S&P 500. So what is the S&P 500? Very interesting. The S&P 500 is a stock market index that tracks around 500 of the largest companies in the US. Examples of those companies are Nvidia, Tesla, Amazon, Meta, Google, and so on and so forth. So if you invested $100 in 1996, your money will have been worth $860 today. And that's a return of investment of about 7.37% when you take inflation into account. So for an index fund, instead of putting all your money into one company's basket, you are spreading your money across different companies. And that makes your investment diversified. Now you've known what to invest in. How do you actually invest? So here's a step-by-step guide on how to actually go about investing. So number one is that you pick an investment app. Wherever you are in the world, this is just a website or an investing app that you can use to manage your investment. And the key thing to look into is that when you are picking these investment websites or apps, you must make sure that they are regulated, you must make sure they are reputable, you must make sure they have low fees. Number two, once you have now opened this app, the next thing to do is to actually put money into the account, and you can do this through bank transfer or debit card. Next is that you choose an investment, and as I've explained earlier before, as a beginner, it's best to start with an index fund. Keep in mind that investing is not a get quick hit scheme. It actually takes time. So don't take your last $100, your last $150 and say, oh, I want to invest it into a double and then I can go and use it to do. No, it does not happen that way. Right? Have money set out particularly for investing. That okay, this month I want to use this amount of money to invest. And then you put that money there and let that money grow over time. What if it all goes wrong? Now, this is the $1 million question. I think it's at the back of a lot of people's mind, right? And it's okay to have that question at the back of your mind. So, what if you invest in a company and the company does not go again or the company crashes, right? So, that's why we talked about index fund. Index can actually protect you to some extent because your money is spread across different companies, and therefore, that's diversification in a sense. So your money is diversified across different companies. And so when there is a crash or when a company stops growing or whatever, other companies that are growing also helps to keep your fund going. The biggest risk of investors is not even the market itself, it's themselves. Now always thinking when you see that the market goes down, or yeah, it means that there's a market crash or whatever, people begin to panic. And when you are panicking, you make bad decisions. For example, you go and sell. Yeah, worst case scenario, you sell, and then when everything comes back to normal, by the time you now decide to buy back, the stock has gone higher than what you sold it for, and now you have a loss. Best case scenario, if they are still the stock price does not go higher than what you bought it for, and they are still able to buy it back again. As a beginner investor, you need to discipline, you need to work on discipline yourself. And this does not happen overnight, right? It takes time, it takes patience, and it takes focus. You have to be focused and you have to be determined that I want to invest my money. And this is the funny thing. Like I'm talking like personal experience. I know that a lot of people can also relate to this. Time flies very fast. Very, very fast. Time flies. I can see when I was very small. I can see when I was in primary school. Now, here I am. Here you are. And in the future again, if you are not married, before you know it, you'll be married. Before you know it, you have kids. Time flies. So you are thinking, oh, if I'm investing, that's another 5 years before my money may have grown to something, Stop thinking that way. Just start. Because before you know it, in the blink of an eye, 5 years has come, 5 years has gone, 10 years has come, 10 years has gone. So invest that money, put that money to work, and let that money grow over time. So if you've been thinking of investing, you don't know where to start, you don't know how to go about it, I hope this video has actually given you some clarity and has helped you. And if you've been able to watch the video to this point, that means you enjoyed the video. So please make sure you drop a like, hit that subscribe button, and turn on notification bell. See you guys in the next video.